Welcome to the Wealth Nation podcast, a podcast for every mother, daughter, grandmother, sister, and wife, and the men who are smart enough to tune in. The Wealth Nation podcast brings you all you need to know about investments, business, property investments, personal finance, and all-around financial wellness. Here is your host, Yolanda Rose.
Hello and welcome to episode 101 of the Wealth Nation podcast. I am wealth advisor Yolanda Harry Prasad, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage your money well and to build generational wealth. And I really try to simplify things for you on this podcast. And for the next couple of weeks, we're going to be talking about investments, and specifically, we're going to be talking about asset classes. So I'm going to be giving you some ideas on what asset classes are, how they impact you as an investor in the various forms of investment, and how to manage your risk using asset allocation. The Wealth Nations podcast is sponsored by Solomon Wealth Management. Solomon Wealth Management is an innovative team of wealth managers that addresses the entirety of your life, your family, your business, your future, one facet at a time. We use our skill and expertise to the consideration of what you have accumulated, how best to administer it through life's changes, from financial counsel on managing your wealth to careful contemplation of how to transfer it to future generations. It's your vision combined with our skill and expertise to help you reach financial excellence. Reach out to Solomon Wealth Management at www.solomonwealth.co.za for a free wealth management consult. So that's Solomon Wealth Management, a brand new sponsor of the Wealth Nation podcast. And just a heads up, Solomon Wealth Management is my baby. It is my own private wealth management firm where I'm taking on clients personally one-on-one. And I want to help you a lot more in a far different way, in a bigger capacity when it comes to your wealth and your finances. So go check out our website. It's www.solomonwealth.co.za. Lots of really nice resources there as well. And if you want me to get hands-on with you in helping you guide you through your financial journey, sign up on any one of those platforms and book a complimentary wealth analysis session. So today we're talking about asset classes. This is just a basic introduction about what asset classes are. And as we proceed in the next couple of weeks, we'll talk a little bit more in detail, and you can see how a strategy will come together from asset classes. And that being said, any content that you hear or see from me on my various platforms, it is not financial advice. It is financial education. If you want financial advice, reach out. Okay, you know my websites. It's solomonwealth.co.za and Financially Fabulous Females as well. A plethora of content on both those platforms. And a lot of the content I put out, it's a little bit of everything. So you can't just take one facet of information and apply it to your strategy. I give you the information in snippets, and I wanted to register with you. And then from there, you can take an informed financial decision.
Raising financially savvy children involves teaching them a variety of skills, from budgeting to planning to earning and saving. Besides giving them an understanding of the value of a rand, it prepares them for real-world finances. Financial literacy is a vital skill, and it is never too early to teach your kids about money. Many parents wonder how they can teach their kids about money and where to find age-appropriate resources. You can now purchase the Financial Literacy for Kids workbook, which is aimed at primary school kids. It's now available at www.financiallyfabulousfemales.com. This workbook provides you with 12 lessons, activities, lesson plans, discussion points, and quizzes that you can use to test your kids' knowledge. Shop now at www.financiallyfabulousfemales.com.
Like what you hear so far? Make sure you never miss a show by subscribing on Apple Podcasts, Spotify, or Tuned In. Now back to the show.
Let's try and understand what is an asset class. Well, an asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. So asset classes are made up of instruments, financial instruments, which often behave similar to one another in the marketplace. Now, historically, in South Africa, we've basically bounced around four main asset classes. And that has been the equities portion. And by equities, we're referring to shares here. Then there's the government bonds. Then there's cash. And when we speak of cash, we're talking about money market and foreign currency and property. Now, if you want to know more about property, be sure to check out the Financially Fabulous Females YouTube page. We have a whole series on property, listed, unlisted property. I break down the entire property investment sector for you from REITs, everything. It's very detailed, so go and check out that playlist on YouTube. So let's talk about equities for a minute. So equities basically represents ownership, and specifically in this case, we're talking about ownership in companies. So when you purchase shares in a company, you're purchasing ownership in that company. For example, if company ABC has 100,000 shares and you buy 1,000 shares, which is equivalent to 1%, you own 1% of that company. And as a part owner, you have a rights portion of the company's profits, and these are usually paid out to investors in the form of a dividend. Dividend amount varies by company. It basically varies on the market, and we find now with companies coming out of COVID and the lockdown, a lot of companies are choosing not to pay dividends for this period because their cash flow has been low. But there are a number of circumstances that come into play when the board decides to divvy out dividends. The times investors choose to take those same dividends and reinvest in the company and get more shares in return. And this just spurs on the company for growth. So although the shares are lumped together, the same investing principles should not apply to them as a whole. For example, investing in a hyper-growth startup is very different from investing in a blue chip stock that's been around for decades. Right, so that's basic share ownership. You can go out on the various stockbroking platforms in South Africa and purchase shares, or you can put a layer of protection between you and invest in shares via other platforms like ETFs or unit trusts, for example. So the next asset class is fixed income or debt or bonds, as we call it. So whenever you purchase a government bond, and government bond is basically government's request for us to lend them money. And they won't tap on your door specifically and ask you for this. So what happens is the big asset managers in the country, Coronation, Allen Gray, Signia, they as asset houses have an opportunity to buy South African government bonds. So a company will go, they'll buy R1 million worth of bonds, R2 million worth of bonds, or hundreds of millions of rands worth of bonds, for example. So when a ratings agency like Moody's downgrades us, it basically tells investors that the South African environment is not that good for investing. So this makes the cost of borrowing much higher for the government. And South Africa, luckily, we haven't defaulted on anything, and it's highly unlikely we will default, and that's when the IMF and all of these bigwigs come into play. So South Africa has to pay extra to borrow, which means that if you invest in government bonds, South African government bonds, you basically are lending the government money, and they're paying you interest. And maybe every 10 years or every 5 years, there are different kinds of bonds, and they will pay you interest for using your money for inverted air commerce, infrastructure development. Unfortunately, in South Africa, we know where that money goes. But that's how basically bonds work. And you can't buy them directly like yourself. I think in other countries like the US, you can buy them directly. But we have to go through an institution. So bonds tend to be very safe. It's basically a loan that the government promises to pay you the interest over a period or at the end of the period. It all depends. Now, companies can also do this. And they can do this in the form of debentures, where they are looking to raise finance, they want to expand, they want more money for research and development for their products or services. And they issue the debentures, and it's basically us buying the debentures, and we're loaning the company money, and they pay us interest. Basically, that's how it works. So interest payments are paid to the bondholders throughout the life of the bond, and the principal is returned at the end of the term, referred to as the maturity date. So if you buy a bond, a 5-year bond with an interest rate of around 8%, maybe you'll receive biannual payments of that interest. So that's how government bonds basically work. It's a fairly safe investment. South Africa, because been downgraded so much, people just flock to South African government bonds because they got to pay more interest compared to the other foreign governments. Then is the cash and the money asset class. Now, cash is money in the form of currency. And if you're a wealth insider and if you're looking at our gold segment on that membership platform, you'll know what money really is. So cash in the form of currency is both local and foreign. This can include hard cash, physical bills that you can hold. You can hold dollars, you can hold euro, coins, and the cash that you have in the bank accounts. Now, cash equivalents like money market holdings, these are highly liquid investments that can be readily converted into cash. In South Africa, if you have internet banking, you can literally move money into your money market account in and out. Typically, I advise my clients that money market accounts are parking bays. For example, if you've gotten your tax return back, and as soon as that money hits your account, you should take it and put it in your money market. Call your financial advisor. Look at what investments are out there right now, what bonuses you're getting, what guarantees you're getting, and put that money in the money market because you're getting some interest rather than sitting in your checking account with no interest at all. Now, as always, anything in the bank, the interest rates are pretty low. So that is why it's temporary. So unlike shares and other assets, cash must be determined by the market price that the interest does fluctuate there. And the last asset is property or real estate. And this is the ones that you can touch and see and feel. And these are grouped into their own asset classes. And real estate is the most common type of tangible asset that people are looking to own. So the property segment in South Africa has been dismal. Please check out the property investment playlist that we have for you on the Financially Fabulous Females channel on Facebook. Break it down really nicely over there. So I won't go into too much detail here. You got to go check it down there. A nice diagram, easy to understand. So it's all for you available on YouTube. So as financial advisors, we use a combination of these asset classes to bring about diversification for our clients' investment portfolio. Each asset class is expected to reflect different forms of risk and return. And they perform differently depending on the circumstances of the market. So investors interested in the maximizing return often do so by reducing the portfolio risk through asset class diversification. And we're going to be talking about this in a couple of episodes' time. We will talk about how to diversify and come up with a diversification strategy. So financial advisors focus on an asset class as a way to help the investors diversify their portfolio. Different asset classes have different cash flow streams and varying degrees of risk. So investing in different asset classes ensures a certain amount of diversity in investment selections. And diversity, as always, reduces the risk and increases your probability of making a return. And that being said, when it comes to investment, don't invest money that you need. Whenever you invest, unless it's a guaranteed investment, always be aware that you can lose it all. Another important part of the financial advisor's performance is constructing a portfolio with a blend of asset classes that meets an investor's risk profile. So at this point, if you don't know what your risk profile is as an investor, reach out to us. Click the link where you are listening to this podcast, and that link is going to take you to a complimentary risk profiling session where we'll ask you a series of questions and I give you some insight into the type of investor that you are and what you should be investing in. All right. So when it comes to equity is high risk. And that being said, with the risk being high, the reward can be high as well. But remember, you can also lose since the risk is high. So the potential for loss or the volatility is extremely high as well. The next asset class is property. Property basically provides medium risk, medium reward, and medium volatility. So you can see the pattern here: high risk, high reward, high volatility. Property, medium risk, medium reward, medium volatility. And bonds and cash, both low risk, both low reward, both low volatility, because very rarely does it fluctuate. It's interest payments. You know what interest is coming, when it's coming, what to expect with your money. Whereas equity or shares are all over the place, very high risk. It can be up 1 minute, next day come crashing down. And that's the kind of volatility that you can expect on the share market. Now, the thing, with these kind of asset classes, when it comes to the rewards portion, everybody wants the high reward. But nobody, very few of us are willing to stomach the high risk and the high volatility. So if you can't stomach the high risk and the high volatility, you shouldn't be very heavily invested into that equity market. Look for something more safe, and we can give you a blend when we're constructing as an advisor. When we construct that portfolio for you, we can give you a blend of equity, properties, bonds, and cash with a fairly reduced exposure to equity if you just can't stomach the risk. Now, currently, most investment professionals, that's including the futures traders, the commodities traders, and other financial derivatives, even cryptos, they have a place in the asset class mix as well. And investments assets include both tangible and intangible instruments that investors are ready to buy for the purposes of generating these incomes. And with that being said, when it comes to the 4 asset classes, you can add crypto and the various other options that I've discussed into this risk grid. And we find South African banks haven't really embraced crypto, but American banks, Western banks are slowly coming on board and offering crypto investments, crypto ETFs. We have a crypto ETF, a crypto basket investment in the country as well. So if I had to place crypto on my risk matrix that I just discussed with you, crypto is extremely high risk, extremely high reward, and extremely volatile. You've seen the price of Bitcoin just rise and collapse in a matter of hours. So that's the kind of volatility that's in crypto, and the futures and the CFDs and commodities as well. Also, if you're trading the commodities in the futures market or the CFDs market, with the leveraging that happens, the risk is very high that you can go over the limit and risk unnecessarily. So it's a very high risk investments, futures, CFDs, and commodities, very high reward and very high volatility as well. So these are the two investments that just supersede the equities risk on a much larger scale. If you want to see this matrix that I'm talking about, join us on our YouTube channel, the Financially Fabulous Females YouTube channel, where I'll be breaking this down in a lot more detail there. So I know for those crypto investors that are that's all you do. You in Bitcoin, you in crypto, that's it. I highly encourage you to diversify because of the risk, because of the volatility, and sit with a financial advisor and try to understand your risk level, your risk profile, and allow them to construct a portfolio for you. So if your portfolio includes investments across the 4 basic asset classes of equities, cash, property, and bonds, it's considered balanced, which is ideal because this will help you reduce the risk while maximizing a return. If your portfolio is particularly heavy in one sector and that sector basically underperforms, like Bitcoin did this week, it could be in trouble. So that is why I say diversify, because if crypto is having a bad week, you can always count on something like bonds and cash too, to hold down your portfolio. The purpose of having all 4 of these asset classes represented in your portfolio is not only to prevent investment downfalls, but also to take advantage of the strengths of each class. And as you know, bonds and cash stay fairly constant. You'll get the slow and steady growth, while your equities, they're up and down and all over the place. And if you're in the right equity investment portfolio, you will see long-term growth. That is why when you do invest, you can't put in some money tomorrow and expect some return next month. All right, you want to be on a long upward trend. You want to be investing 10, 15, 20 years for you to see some really solid growth. The whole theory of asset class allocation is based on diversifying your portfolio by asset class. And you never want to find yourself in a situation where your portfolio is reliant on one asset class to carry the weight. So shares give you a chance for higher returns because of the higher risk, as we discussed. Bonds don't offer the substantial gains as does equity, but they're one of the more safer investment options. So it's on to you to find out which combination of assets make the most sense for you. And you can do that by getting a risk profile done. The younger you are, the more aggressive your portfolio should be. And as you get closer to retirement, you would want to get into the more conservative side because you don't have much time to rebound in event of a market downfall. So a portfolio that only contains one or two asset classes is not very diversified and may not be prepared to take advantage of all the swings that can occur in a market. But diversification, at least a degree of which you diversify, is also an individual decision, and it's highly personal, and it depends on some extent on your goals and your risk appetite. If you're very risk adverse, you might want to diversify even more, or make sure that you further diversified within each asset class. And within the four asset classes we spoke about, there's sub asset classes as well, but we'll go into detail on that in another podcast episode. So you can diversify even further in each asset subclass. If you have really have nerves of steel, and if you're lucky enough to have money to burn, you might not want to rely on the diversification quite as much, but ride the trends of the market instead. And that comes with, your investment strategy. And if you look a few episodes back on the Wealth Nation podcast, we went through a couple of investment strategies like value investing and things like that, dollar cost averaging. And that'll give you a better idea how to really use those kind of strategies with the asset classes. So where to from here? Firstly, you need to find out what your risk profile is, and you can do that by clicking the link where you were listening to this podcast to set up a complimentary risk profile session with me. And I'll ask you a series of questions and identify the type of investor you are, from aggressive to moderate to conservative. And I'll give you guidelines as to what you should be investing in based on your risk tolerance. All right, so click that link down below. I'd love to have a one-on-one chat with you. That's it for me on this episode of the Wealth Nation podcast. I will talk to you next week.
Thanks for tuning in. Make sure to visit our website at www.financiallyfabulousfemales.com and sign up for our free investment masterclass.